Good morning, Trinidad and Tobago. Season's greetings and welcome to the Bourse Report. Today we're talking about Scotiabank Trinidad and Tobago Limited as well as Agostini's Limited for their financial years ended October 2019 and September 2019 respectively. Both companies would have reported improved profits on the heels of muted revenue growth. How did this occur? Let's take a look. Turning straight to Scotia, and for its financial year ended 31st October 2019, earnings per share was just around $3.79, which was a 4.4% improvement on the $3.63 reported in the prior comparable period. Now, total revenues were up just around 1.5% from $1.83 billion to $1.86 billion. And in fact, income before taxes were down marginally, just from $957.4 million to just around $949.2 million, so about a 1% decline. However, a decrease in provision for taxation by about 11.3% did increase overall income after taxation by around 4.3%, from $640.8 to $668.3 million there. Now, in terms of revenue composition, no surprises here. Retail, corporate, and commercial banking continues to be the highest generator of revenues for Scotia, with accounting for over 90% of revenues in fiscal 2019 at $1.68 billion in that purple column, followed by insurance services with revenues of just around $165 million, and asset management, $7.73 million in revenues, or just about 0.4% of total revenues. Now, things could be set to change with the potential transaction to be concluded between Scotia and Sagicor in 2020, involving the sale of its insurance operations to Sagicor and a distribution agreement being put in place between Sagicor and Scotia. Now, will that impact dividends? Well, as we can see, the dividend history for Scotia can be best described as consistent. Over the past 5 years, the company has paid out dividends in total, comprising special and regular dividends on an annual basis of just about $3 per share. And as you can see, very consistent over the past 5 years. Now, with the potential sale pending legislative agreements, legislative approval, that could be set to change. Two things for investors to consider. Going forward, will the dividend paid out by Scotia be lowered, or will it remain consistent? Is there capacity for that to happen? Well, on average right now, Scotia pays out just about 80 cents of every dollar earned. So there is some wiggle room, but maybe not as much as investors might be comfortable with. The second thing to consider is that there could be the potential for a special dividend from the sale of those insurance operations. Again, time will tell whether these things materialize. So at a price of just around $59.76, Scotia is trading at a price-to-earnings ratio of around 15.8 times, which is above the sector average of around 14.8 times, and it does have a quite healthy dividend yield of around 5% at the moment, compared to the sector average of 3.9%. And as mentioned, that dividend payout ratio on the higher side of the sector at around 79.2%, relative to the sector average of around 55%. So on the basis of muted revenue growth and some consistent increases in earnings, but generally above average valuations, Bourse maintains its neutral rating on Scotia. Turning quickly to Agostini Limited, and for its year ended 30th September 2019, earnings per share was $1.76 versus that $1.66 in the prior comparable period, a 6% improvement. Profit attributable to shareholders was impacted by muted revenue growth, just around 0.6% up from $3.25 to $3.27 billion. Operating profits, however, were up 13% from $218.2 to $246.6 million. Some cost containment initiatives certainly bearing fruit, it would seem. When we take a look at that revenue history, again, fairly muted revenue growth over the past 3 comparable periods. However, that profit before tax margin has increased from around 5.71% in that fiscal 2017 period, consistently to that 6.7% recorded in fiscal 2019. So certainly some cost containment initiatives seeming to bear fruit there for Agostini. At its current price of around $24, the company trades at a price-earnings ratio of 13.6 times, which is below the sector average of around 15.9 times, and offers a trailing dividend yield after falling as low as 2.7% to its current level of 3.3%, which is above the sector average slightly of 3%. Now, on the basis of fairly slow revenue growth, but improving earnings, Bourse maintains a neutral rating on Agostini Limited. That's it for this week's edition. For more information, give us a call at 226-8773. Check out our website at bourseinvestment.com. Email us at invest@boursefinancial.com. And if you are a Sagicor shareholder and would like to find out more about your new Sagicor shares and how you can deal with these new holdings, trade them, deposit them, etc., tune into our absolutely free webinar this Thursday, December 19th at 2 p.m. That's it for this week's edition. This has been the Bourse Report. Have yourself a great investing week.